Thank you very much. My name is Dr. Brian Taylor. I'm Chief Economist and co-founder of Global Financial Data. Global Financial Data is the only provider of long-term alternative historical data. Now, the reason we say long-term is our data doesn't go back 30 years or 50 years. It goes back several centuries. And we have the longest data available of any source in the world. And that's why we say history is new, history is now. Because we differentiate between data coming from when computers were able to provide the data and when the data actually began. So we go back to the original documents. We've gone back to data that monks had entered back in the 1200s, collected the data, put it into a machine-readable format so that our customers could understand it. Now, let me tell you how Global Financial Data began. I was a broker 25 years ago with Dean Witter, and I had customers coming to me who wanted to understand what's going to happen if they invest over a 50-year period. The problem was I didn't have 50 years of data. So how could I tell them what was going to happen 50 years from now if I didn't have that data? So I went back and I started collecting it. I went to archives around the world and collected the data, Xeroxed it. I drove librarians crazy collecting the data and put it into a machine-readable format. Once I did this, I started showing it to other people, and they were amazed that this data was available. The feedback that we get over and over again is, I didn't even know this data existed. And that's because no one else has gone and collected the data and made it available. Our most prominent product is the GF database. And you can see the time periods that the data begins. We have stocks, bonds, and bills back to 1692, fixed income back to 1700, commodities back to 1000 AD, data on silver and rice from China, exchange rates, economic data, GDP, and so forth. So we have collected centuries of data in order that people can understand what happened in the past in order that they can predict what's going to happen in the future. In addition to the macroeconomic data, we've also collected unlimited amounts of data on individual companies. We have two databases. We have the UK equities and the US equities. Now, the data for the UK goes back to the 1600s. We have collected daily data on individual companies from the London Times, the Course of the Exchange, the Financial Times, other magazines that existed, converted that into a machine-readable format so that anyone can access that data and see how markets have performed. There are thousands of companies worldwide that traded on the London Stock Exchange. And what few people realize is that emerging markets traded on the London Stock Exchange, beginning back in the 1820s. And we have collected data from all of these countries. If you're looking at emerging markets data, most sources only have data back to maybe the 1980s. We have data on emerging markets back to the 1800s, on the individual companies, and in addition to that, indices that show how different sectors performed, how different countries performed. And we've linked that up to the current data for those emerging markets so that you can have a history that covers centuries, not just decades. We then did the same thing for the US market, and we didn't limit our analysis to New York. We looked at regional exchanges as well in order that we could cover every major stock that ever traded on every US exchange, including regionals. Now, 200 years ago, when you first had trading, you had three markets in Boston, New York, Philadelphia. Over time, new regional markets came into existence. And by 1929, at the height of the stock market, there were over a dozen regional markets throughout the United States. Each of them had stocks trading on them that were not traded elsewhere. No one else has ever collected this data, organized it. There were also over-the-counter markets. Most banks traded over the counter. Few people realize that finance companies aren't even included in the S&P 500 before 1976, we have all of the historical data prior to 1976 for banks or insurance companies so that you can analyze this. Then, beginning in 1929, regional stock markets started to merge. And today, you only have the New York exchanges. You don't have exchanges throughout the country as you had back then. This is why we say we have no survivorship bias, which means that we provide data on delisted companies, and no exchange bias, because we have data from all the exchanges. No other company has the data on the regional exchanges that we have. With this data, we've been able to put together our GFD indices. And these are 4 indices that we have put together for the UK, the US, world, and the 10-year bond. And as you can see, these indices go back further than anyone else. Let me show you what these indices look like. This is the index for the UK. What we did was we chose the top 100 companies and each year by market capitalization and calculated an index that's market cap weighted based upon them. This is what the index looks like going back to 1700. We have a similar index for the United States, which goes back to 1792. You can see the Civil War, you can see the Great Depression, you can see the dramatic increase after World War II there. But our longest index is our global index, which starts in Amsterdam in 1702 when the Dutch East India Company started trading and goes all the way to the present in 2019. You can see the spike there for the South Sea bubble. You can see the Civil War in the 1860s. You can see the Great Depression in 1929. All that data is available. The final chart I wanted to show you was a chart for interest rates over the past 200 years, back to 1786. And as you can see, most people just look at the decline in interest rates. But interest rates now have gone back to the point where they were at in the 1940s. So in order to understand what's going to happen in financial markets over the next 10 years, you need to study what happened in the 1940s, the 1950s. If your data provider doesn't have that historical data, it's going to be difficult for you to understand what will happen in the market. Another important module that we have is the events in time, which covers over 80,000 events. So if you're not a history major and you don't know what happened in 1929 or 1720 or 1865 or any year like that, you can use our events in time to go back, put in particular dates, and see what were the factors that drove the market at that point in time. For example, in 1720, you had the South Sea bubble. After you learned about that, you could go and generate a chart that shows how the price of South Sea stock increased from 100 to 1,000 and quickly collapsed after all the investors left the stock. This is why we differentiate between macroversal, which is the top level for the GF database and the GFD indices, and the microversal, which is what you have for the individual companies, for the US equities, the UK equities, and then using the events in time to understand the relationship between the two, the correlations, the connectivity that exists. I wanted to show you one way that computers have been used to analyze markets. This is a picture of Garry Kasparov and Deep Blue. And as you probably know, back in the 1990s, Deep Blue, IBM's computer, was able to beat Kasparov, who was grandmaster. It was the first time that a human had been beat by a computer. Now we just assume that a computer is the best player at chess. But what was really interesting was what happened a few years ago in the game of Go. Go is a much more complex game than chess is. And so the AlphaGo computer by Google was used to study past behavior of Go masters and develop algorithms which enabled the computer to play as effectively as possible. Then, after the computer had developed algorithms to play against human players, the people at AlphaGo had the computer play itself so it could learn new moves from itself. And then, after it had built up all of these algorithms to understand how to play the game of Go, it played Lee Sedol. And in game 2, move 37, AlphaGo made a move which no one had predicted, which Go masters are still studying to understand how they did it. And once that move 37 was made, the game was over. Lee Sedol could not win the game. But what was even more important with that was game 4, move 78. Lee had started to study what AlphaGo was doing, and he learned from AlphaGo. And in move 78, he made a move that flummoxed the computer, and Lee won the game. And so the real challenge now is in financial markets and how to use financial market knowledge of the past to understand the future. And we have 5 databases, as I indicated, which cover all of the aspects of the market. The macroversal with the GF database, the GFD indices, the microversal with the US and the UK equities, and the events in time to link them together. By studying the connectivity between all these indices, you can generate alpha and higher returns by studying the past. One of our clients has gotten a 35% annualized return over the past 20 years. That has turned a $10,000 investment into $4 million. That's a significant return. So by using GFD's alt data, you can push the boundaries of human thinking. You can use AI and machine learning to understand the past in order to look at the future. So my question to you is, what is your next move? What is your move 78 that you're going to use in financial markets based upon what you've learned from the past? Thank you very much.